Hi, this is Stacey with Envision Financial Planning, and I'm here today with better financial health in 15 minutes or less. So what I wanted to talk about today is something I've gotten a couple of emails and phone calls just in talking to clients, friends, and that's what's going on with the market. The market's been down. I really liked it last year. It was up. It was great. Should I sell everything now? And I'm hearing that, the markets are going to be down 90%. What should I do? So there's a lot of fear out there. But what we have to remember is that markets do this. This is normal. Last year was kind of crazy. If we think about it, at the beginning of the year, we had vaccines coming along. We had the CDC came and said we didn't need to wear masks. How great was that? And then we had Delta popping up, and then now we've had Omicron. And so there was a lot of scary stuff. We also had a lot of supply chain issues, boats stuck. Seems weird to call something that's half a mile long a boat, but it's still a boat, stuck in the harbor off the ports of Los Angeles in California. So we had a lot of stuff we couldn't get stuff we needed. Inflation picked up. It was all this scary stuff going on. But when we look back at 2021, the market pretty much went up throughout all of it. And that's what you have to remember. There are some scary times where markets come back. Go back to 2008. That certainly was scary. But markets are forward-looking. They take that into account. What impacts markets is what companies can earn, and also what you can earn on other assets. So what does that mean? It means that trying to predict which way the market's going to go, it's really a losing game because we don't know, because we can't know when the next pandemic's going to be there, what's going to be the next variant, what's going to happen to inflation. We just can't know that, and the markets take that all in all the time and get there. So what you need to understand is last year, man, it was great. You didn't have to think about it every time you opened your statements. It looked great. There was one quarter where it kind of was flat. That was the third quarter. Everything else really looked super. So what you have to keep in mind is that it's normal. The reason that you earn 10, 15, 20, 30% in the markets instead of the 0.1% you earn in your savings account is because at any one moment in time, the markets may be down 10%, 15%, but over time, the averages with stocks outperform everything else. And that's why you need to take that risk. One thing that I would tell you when you think about this, it can be scary and upsetting. And so one thing we would say is sometimes you just need a hug and go to somebody, go to one of your friends, go to one of your loved ones and get a hug and just get them to tell you it's going to be okay. Because then it's easier to take these facts, which they are facts and they are true, but when we get emotional about money, sometimes what we need first is a hug. So go hug your people and then think about and look back on what history has shown us is that this volatility is normal, and just having a diversified approach, meaning that you own large company stocks, you own tech stocks, you own bank stocks, you own European stocks, you own stocks from all over the world, and then you balance that with enough in savings, enough in bonds or fixed income to get you through these volatilities. Kind of think of those as shock absorbers, and then don't worry about it. Go live your life. You'll have a lot more fun, you'll worry a lot less, and hug your people. And thank you for tuning in. That's another episode of Better Financial Health in 15 minutes or less.